Kristina Hooper is with us, Chief Global Market Strategist at Invesco with a 2020 outlook as well. Nice to see you.
Great to see you.
So I know that we've had a little bit of volatility this week. Doesn't look like we're going to have a winning week again like we have the last 6 for the S&P, but we're still 0.5% away from these all-time highs. So what are your thoughts going forward?
Well, certainly there is one very strong form of jet fuel powering this stock market, and it is the Fed. I think it was really important that we heard from Jay Powell at the last FOMC meeting press conference when he said there's a very high bar for raising rates. That was a very powerful message, and I think that has a lot to do with where we've seen stocks go over the last several weeks. And of course, that suggests an accommodative environment and a supportive environment for equities for the next year.
Yeah, it doesn't feel like they're going to raise rates in our lifetime. I mean, the way they're putting it out there, they're so dovish. We know that they're ready to be accommodative if needed, but very much in a pause right now. But to your point, no sight of raising rates, no sight of inflation. The consumer is still strong. Manufacturing, the flash PMIs are improving. So what's your outlook for 2020? Where do you see the growth?
Well, we actually feel more positive about the stock market than we do about the economy. We expect the economy to decelerate somewhat, hit an inflection point early in 2020, and then start to reaccelerate. But again, very sort of lackluster growth for 2020. However, the stock market has this wonderful engine, the Fed, and its very accommodative stance, which doesn't really sync with what economic conditions are like in the U.S.
Central banks all around the globe that are very accommodative as well.
It's more than just the Fed. It's creating an accommodative environment that's supportive equities globally.
Right.
So that should be a real positive for markets. So our expectation is solid positive performance in 2020, even if we get somewhat mediocre growth.
So you see high growth areas such as Asia, emerging markets, China in particular, and less so for UK, Europe.
Sure. There are still so many question marks around the UK. It is a poster child for economic policy uncertainty, and it doesn't look like those issues are going to be resolved anytime soon.
I mean, are people very interested in Brexit, or are they done with it? I mean, what's going on? I mean, I don't go out and hear a lot of people talking about Brexit.
Well, and if you go to Europe, there's a fair level of Brexitegue. Because they've talked about it so much for so long.
Yeah.
And so I think it continues to be something that will pose question marks for 2020. This is not a scenario where we're likely to see a resolution very soon and then it's over. It will continue to persist as an area of real uncertainty. Add to that, of course, the U.S.-China trade wars. That is the other potential risk and the much greater creator of economic policy uncertainty globally.
Give me some good news for the U.S. going forward.
Well, the really good news for the U.S. is the Fed, but also the economic conditions within the U.S. are fairly good. In particular, you have an American consumer that is healthy and is, for the most part, spending. Now, we can't,
we got a consumer sentiment number in today, better than expected.
Exactly. Not all the data points are great, but the picture that it forms is one of a very solid economic environment, and one in which consumers continue to spend. So we just want to follow labor market metrics very closely because the consumer is vulnerable.
And how about the housing market? That's pretty good, too, lately.
The housing market has been good. I mean, a lot of it depends on the region, but in general, relatively low rates have been supportive. So there's a lot going on that's good in the economy. Really, where we've seen sort of the most disappointment is probably around the business side and sort of that tamped down, depressed business investment. We could certainly see more business investment, but I don't think it will happen until we resolve the U.S.-China trade war.
And what do we think about economic growth going into the election? You have a business-friendly administration, lower taxes, less rolling back on regulation. You also have the Democratic Party with a lineup of very serious contenders. What happens to the markets in the different scenarios?
Well, I think one thing we can assume, no matter who is elected in November of 2020, is that we're likely to see more fiscal spending rather than less. It will be fiscal spending on different things, but conventional wisdom is starting to agree on the fact that even if we were to have an Elizabeth Warren as president, we'll see more spending. It might not be business-friendly spending, but it would be potentially consumer-friendly spending. Right. So I think in general, what we are looking for is more fiscal stimulus. That's what we're hearing all over the globe. It's a common theme. We may very well get it in the U.S. no matter who is president.
And the China story with the kick the can down the road here, we got so many mixed reports this week. Few Chinese want to have the deal done, and then the very next day, there's talks about meeting in Beijing and that President Trump and President Xi are interested in doing something. So as long as they keep talking, are we fine? Is that pretty much what we're going to do now through the election?
Well, as long as they keep talking and no tariffs are increased, then that is a good scenario, because I think it's going to take time before we even get to a phase one deal. There are a lot of issues that haven't been resolved that were quite simple.
Right.
And so that suggests to me, as long as they keep talking and they don't raise tariffs, that's probably the most we can hope for.
What about the currency wars or things like that? What are some of the downside risks?
Well, certainly one of the big downside risks of the trade wars is that it really does create a currency war as well. And so we are on the cusp of something like that. We're already seeing signs of it. But again, a lot of it has to do with how this trade war plays out and whether or not we go deeper down the path of currency wars.
And when you talk about sectors, do you have certain sectors that you like more than others?
Sure. So if you look at it from the standpoint of what our expectations are for 2020, it's going to be a relatively low growth environment, but keep in mind an inflection point and a reacceleration during the year. So that suggests there will be a period where cyclicals outperform, although for the full year, we're likely to see growth still outperform. So we want to take a barbell approach. Emphasize the higher secular growth areas like technology, but then also have some cyclicals as well as higher yielding parts of the market, because we are financially repressed and look like it's going to continue. So telecom, utilities, and REITs. REITs are offering really nice yields. So that barbell might stand investors in good stead in an unusual environment like 2020.
Right. This way you're protected. If you have the run, you're there for it with the technology. And if things start to slow down, you have the dividend-paying utilities and REITs. I understand. It's great to see you.
Great to see you,
Kristina Hooper, Chief Global Market Strategist at Invesco.